Hello, everyone. My name is Chris Lamont, and I am the Operations Manager of the National Youth Orchestra of Canada. It is a great pleasure to welcome you to today's webinar, Taxes for Musicians Demystified. I would like to start by acknowledging the land we are on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabeg, the Chippewa, the Haudenosaunee, and the Wendat people. It is covered by the Treaty 13 and the Williams Treaty, and is home to many diverse First Nations, Inuit, and Métis people. Throughout the workshop, please submit any questions you have through the Q&A. And now to introduce our special guest, Sunny Widerman.
Hello all.
Sunny has been preparing income tax returns for entrepreneurial Canadians since 2002. She specializes in helping clients take control of their tax planning by explaining the tax issues that directly affect them. She has been featured by Advisors Edge, the Canadian Media Guild, and the Professional Writers Association of Canada. Through her firm, Personal Tax Advisors, Sunny has filed over 1,000 returns to date, and whether you file on time every year or you have several overdue returns, Sunny is here to help. Welcome, Sunny. Thank you for being with us.
Thank you for having me. All right, let's get this show on the road. I'm very honored to have been asked to do this presentation. Doing this kind of presentation is something I really feel very strongly about, because I think that it's a very necessary part of being self-employed is understanding the issues of taxes that involve you. And so a little bit about who I am. I have been doing other people's taxes for money since about 2002, and since that time, I've personally prepared well over 1,000 returns myself, and most of them were for self-employed people, and most of those self-employed people were involved in some way in the arts. So it's really been a focus of essentially my entire career as a tax preparer, working with people. And what I have found is that the information that relates specifically to people in the arts is not as easy to find. Certainly, even just information about self-employment and taxes is not as easy to find as it is to find information for like regular people's taxes. And it's one of my missions is to make that information a little more accessible and a little more available to the people who need it. That said, you may still wonder, I find in my years of working with musicians, very few people become musicians because they love taxes. It's just that's not really the reasoning usually that pushes you into this career. And although you've all chosen to be here, I want to talk a little bit about why I think it's so important that you are here. And I like to illustrate this with a story. It's a story I tell quite often, not because it's the only example. Actually, I tell this particular story because it sort of illustrates a lot of things at once, but the pieces of this story happen all the time. And it begins with an email that we received really in the fall, so not during high tax season, in what we call the off season, a couple of years ago. This was from a self-employed, she was actually an actor, so similar to being a musician, slightly different, but the bones of the game are the same. You get gigs, you get paid. She had been making very modest money for the last year, last decade or so, but she had not filed a tax return. In a decade. She had not filed a tax return in a decade, I should be clear. And what tends to happen if you don't file tax returns is nothing at first, and then gradually you start getting letters from the Canada Revenue Agency, assuming you haven't moved and you are still receiving the letters at the same address they have for you, and they will request and then demand your tax returns. But they aren't actually armed, so they can't make you file it. So if you just ignore the letter and you don't file, they can escalate a little bit, and they can potentially freeze your bank accounts. Or in the case of this particular person, what they did was they garnished her. Now, I'm sure you all know, garnishing is this process by which the tax people, the government, gets between you and your earned money. What they do is they contact your employer or anybody who wants to pay you, and insists that the pay that you have earned, first, a portion of it is to be diverted over to the government. So they get your money before you get your money, and it's applied against your tax bill. Now, the issue with her, of course, was that she hadn't filed a tax return, so they didn't really know what her tax bill was. So before they do that, what they do is they just make something up for you. If you won't file returns, if she hadn't filed returns, they will just sort of like guess at what she owed. They put together sort of a return that we call an arbitrary assessment. They call them a notional assessment. They basically make something up. And they present her with 10 years worth of their calculated tax bill, and they want the money, please. And if she won't hand it over, they will divert it from the people who are trying to pay her for her work. So this is what they've done. This is we're getting into the big guns here of the Canada Revenue Agency's arsenal. Now, at this point, I would like to offer a quiz question here. I'm going to say, don't answer the question, answer in the chat. Your guess as to how much of her income the government was snatching before she could get paid. So the payers would try to pay her, but they had to divert what percentage of her income to the government first. And I will say, this is a prize. You're trying to be, whoever is, we're going to use the Price is Right rules. Whoever is the closest without going over gets the prize of basically bragging rights on this one. So we've got a guess here, 50%, 10%, 15, 73. That's a very Price is Right answer. 71, hoping to get that, whatever. Lots of great guesses here so far. Okay, stop. Everybody who has guessed, thank you. Okay. Oh my goodness. I can't believe it. We actually get a winner this time. Bragging rights go to David Chen, who guessed 100%. Every dollar that was owed to her by a payer had to go to the government. And this is why, after 10 years of letters and warnings and threats from the Canada Revenue Agency, this was the reason that this is when we got this email. At this point, when she was no longer able to earn legal income anymore, that is when she thought, maybe it's time to file. Because what she can do if she files, first of all, she can bring that tax bill down, because the tax bill that the government guesses out for you tends to be on the high side, not the low side. And if they've done that to you, you can just file a return and it'll bring it back down again to a more accurate number. And it's also the start of kind of negotiating with them about when to pay and how to pay, and so that they will let you earn your money. So now she wanted to file 10 years worth of tax returns, and she needed a quote from us. And I did my best with this. I gave her as many discounts as we have. I just edged all the prices down, and then I applied a bunch of discounts and whatever. But the thing is that no matter what you do, 10 years worth of tax filing is not cheap. So we came up with a price. It was not a low price. I was really not sure how she was going to find the money, given that she was being garnished at 100%. But I sent her the quote. And to my complete lack of surprise, we did not hear back. For a while. We didn't hear back for a while. We didn't hear back for maybe 3 weeks. And then she got in touch. And she said, I'm sorry I didn't respond earlier, but I've been evicted. So let's recap. She cannot earn any legal money, and she has no home. And this is a kind of situation that we in the tax business, not to bury you in jargon here, but we call this a disaster. She was living a disaster. And with kind of no money to pay us to file the returns, to lower her bill, to get CRA to get off her back. This is, forgive the fairly funny image. I love cats, which is why I enjoy watching them do something dumb. But this was not funny. This was really, really, really bad. And what bothers me the most about this situation is that it was completely avoidable. And as much as she did not want to do taxes, nobody really wants to do taxes. Certainly, people who are self-employed in the arts tend to be self-employed in the arts because they don't like taxes. They didn't, it wasn't like a toss-up. Well, I'll become a violinist or I'll become an accountant. Usually, there's a clear, decisive, not, I don't want to be an accountant in that decision to become a self-employed artist of any kind. So I know that she didn't really want to do it, but the fact is that what she had needed to do during those 10 years when she was building this horrible situation for herself, the things that she needed to do were not that onerous. She needed to know some things and she needed to do some things, none of which would have been as difficult as the situation she was finding herself in. And that's why I do these talks. This is really why. There was no reason for her to be in that situation. And when we finish up together today, we're going to have covered kind of everything you need to know to not find yourself in the position that she or this cat have found themselves in. It's not necessary. And you'll know everything you need to know to stay out of the most kinds of trouble, tax trouble. You can't do anything about your personal lives, but you'll be able to keep out of tax trouble just by knowing what we're going to cover today. And that said, I also don't know that I want you to be too obsessive about taking notes about everything. We will get a little bit technical here and there, but I promise that most of the technical stuff that I'm going to talk about is also available through a couple of resources that I'm going to make available to you all for participating today. So, when we talk in detail about, deductible expenses and we talk in detail about the GST, HST, just be assured that we have entire resources just written for artists, ready for you, free of charge, that you'll be able to have and keep for all time. So don't worry too much if things are going a little bit fast. You'll be okay. You'll get to walk home with something. Well, I'm sorry. We're all home. Well, I'm not. I'm in my office, but most of us don't have to walk home from anywhere anymore, which is sad because we're all home. Okay. Anyway, moving on. I'm also going to stop at several points through the talk to give you guys time to ask me some questions. I got some questions asked sort of up front that I hope will be answered in the process here, but we'll see how that goes. But just so you know, there will be several times to stop and ask questions, and we'll have a little Q&A at the end if we have a bit of time. So I'll do my best to make sure that we cover everything. So starting with the basics and the differences between being self-employed and being a salaried employee. So salary, when we say salaried or when we say employment, what we're talking about is a kind of job where you get a paycheck. You know what it's going to be. You know that it's going to come on a regular basis, once a week, once every 2 weeks, however it works out for you. So, people who don't have to invoice and don't have to bill and that sort of thing, that's what we call employment, as opposed to self-employment, which is when you are a freelancer or, you're working gigs. And that is the type of tax issue that we are really focusing on, because that is where things diverge from what everybody knows about taxes to what fewer people know about taxes, and where, people in the arts really need a little bit of background. So what really makes the taxes involved with self-employment fundamentally different from the taxes involved with salaried employment? The first thing is keeping more money because you can write off business deductions. And each of these points on this slide, we're going to go into in more detail. So as most of you know, in order to maintain sort of employability as a freelance musician, there are certain expenses that you have to undertake yourself, such as the maintenance of your instrument, maintaining a little bit of a home office so that you can actually manage your gigs and so on, storing your equipment and so forth. And that all costs money. Everything costs money. And what happens is you do not get taxed on your gross being what you bill people. You don't get taxed on that. You get taxed on what's left after you've spent the money that you needed to make that money. So you have your fees, then from those fees, you pay your expenses. What's left is what's called your net, and it is your net on which you get taxed. So a salaried person getting a salary of $500 pays tax on the full 500. A self-employed person getting paid $500 first deducts a bunch of business expenses and gets taxed on that amount. So you get to keep a little more money. Next, of course, you have to be aware of the rules involving the GST or HST as it applies to you, depending on what province you're in. This is obviously something every Canadian kind of knows about, that they pay it, but only self-employed people really have to understand a little bit about how it works and when it starts to be something that they have to concern themselves with. So we'll talk a little bit about the GST, always lots of information about that, always lots of questions about that. Unlike a salaried employee, we've all been salaried at some point, I think, where you get your salary, but there's an amount withheld. So they're withholding an amount for taxes, Canada Pension Plan, EI, and those withheld amounts actually go straight to the government in your name. And then when you file your taxes, filing your taxes or preparing your taxes is actually the act of calculating your true tax burden. And then they compare the tax burden to what has already been set aside from you. If what has been set aside exceeds your tax burden, you get a refund. And if what has been set aside is does not cover your tax burden, then you have to pay the excess. And the thing is that while people who are salaried have taxes withheld at source, they don't even get that tax money, it goes straight to the government. When you're self-employed, you have it all, and out of that is going to come tax eventually. So it becomes your responsibility to set aside an allowance for tax. And we're going to talk about how you can decide how much to set aside and where to set it aside to make sure that you're ready for your tax bill when it comes around. And finally, semi-finally, you have other documents that you, as a self-employed person, you have slightly different filing obligations. And by filing, we mean when you send information to the government. That's what filing means. There's different information that you as a self-employed person send to the government, and there are specific deadlines about those filings. The deadlines are very important. We will talk about why a little bit later as well. So you need to know what those obligations, what those things are that you have to file and when exactly they're due. And now finally, you have to keep good records, because as a self-employed person, your taxes are more complicated. You have to apply more knowledge. You have to apply more judgment. You have to make more choices about what you file as part of your tax returns. And because the Canada Revenue Agency can come back to a previously filed return and ask for information and proof and supporting documents and calculations, when you do file your tax return, you're not really finished with it. You have to make sure that you keep your records, and you keep them for the amount of time that CRA could potentially look back and legally demand that you prove yourself to them. So we'll talk about the nature of the records that you have to keep and how long you have to keep them. So let's get straight into point one, which is about business deductions. So as I said, you're going to collect your fees, you're going to subtract your expenses, and what is left is what you get taxed on. So how much you're actually subtracting in business expenses is very important, because the more you can deduct, the lighter your tax bill gets. So everybody wants to know what they can deduct. Now, one nice thing about being self-employed is that frequently some of the things you can deduct are already part of your life. Like, you may not spend any additional money on rent when you become self-employed, but becoming self-employed makes some of your rent deductible. Some of your computer purchase is deductible. Some of your vehicle use may be deductible. So sometimes parts of taxes for self-employed people is just great, in that without spending any extra money, you actually just can file a tax return that makes you pay less in tax. So a salaried person may also have rent and a computer and a car, but they're going to pay tax on their full $500 salary, whereas you as a freelancer, a self-employed person, are not going to pay tax on that full $500. It's going to be $500 minus an allowance for all these expenses that you're spending money on. But beyond this, people want to know what the rules are about what you can deduct and what you can't deduct. So I'm going to start with the warnings about certain things. CRA does not have a rule about every single thing that you could ever possibly deduct, because basically that would mean a rule about every single thing that exists and can be purchased. So they don't have that. What they do have is certain restrictions and, rules about certain expenses, for one reason or another that they don't kind of like. And then beyond that, you're sort of, it's a little more of an open question, but let's start with some restrictions. One that a lot of people get wrong is meals and entertainment. So the Canada Revenue Agency more or less does not accept your groceries as meals and entertainment, unless you're basically buying groceries to feed to somebody else that is a business. I don't know. It's very hard to get away with groceries. Let's just say that. And the other thing is that a lot of people, if they have a long work day and then they go and grab something to eat, they want to write off that meal as a meal, a business meal. And there are some rules about that. Generally, if you're just if all it is that you worked a long day and then so you go and buy a meal, you can't deduct that meal. That's just considered sort of a personal expense. It's your problem. It's not part of your business. What is part of your business is two kinds of meals. One is a meal that you have with somebody else that can, in some interpretation, help you earn money. So this can be a colleague who's working out, who's giving you some information about a gig you might go for, or somebody who's potentially going to hire you for a gig. So if you're looking to get a gig playing at a wedding or something like that, and you have to meet with the bride, that if you spend money on that meal, you can write that off as a business meal because it's a meeting with somebody who may be able to affect in a positive way your self-employed income amount. You're going to earn more self-employment income by having this meal with this person. That is a deductible meal. Make sure to write on the receipt who you met with and what the meeting was about, because if you ever get reviewed or asked questions about this by the Canada Revenue Agency, meals are something they like to check up on. So make sure that you have written on the receipt why it's deductible, which brings us, in other words, because it was a business meeting with so-and-so, which brings us to the other kind of meal that you can deduct, which is a meal while you're traveling. Now, to be traveling, for the purposes of this question, you have to leave your home region for a minimum of 12 consecutive hours. So if the gig takes you away from home for more than 12 hours and then you buy a meal, that meal is a legitimate business expense. So not the meal that is local and not the meal where you left town but you were gone for less than 12 hours. If you were gone for more than 12 hours and also, if you're gone and also for more than 12 hours, that meal is deductible. So I see a question here, for deductible meals, are alcoholic beverages and the tip also deductible? The tip, yes. The alcoholic beverage, maybe. The rule about alcoholic beverages is it has to be a reasonable amount for alcoholic beverages. They don't actually define it beyond that. So it seems to me like if you get reviewed on your business meals and there are a lot of alcoholic beverages in there, I'm not sure that it's clear that the Canada Revenue Agency does not have a clear definition of what is allowable, as what is sort of reasonable amount. So I think you just have to be ready to defend that it's a reasonable amount. It's one of those things, there was a trial in the US in the 60s about pornography, and the judge ruled that I can't define it, but I know it when I see it. And so I think that's kind of where they've left the alcoholic beverages question is we can't define exactly what is a reasonable amount and what is not reasonable, but hopefully you know it when you see it, because that's as close as you can get. Sorry, that's not really it's not a very useful answer, but that's as much as I can tell you because that's all there is. Now, the business use of home. So this is a special kind of expense where essentially the costs related to the part of your home where you have a workspace or space that is sort of devoted to your self-employment income, that is partly deductible. So what happens is the way that the alcohol works. Sorry, we all know how alcohol works. It does this to you. Okay. The way that the business use of home expense works is that you take the full cost of putting a roof over your head. That can be your rent, or if you own your own house, that can be your property taxes and your mortgage interest and your utilities and general repairs. And you end up with this giant number of what it costs to house yourself. And then you take the percentage of your space that is taken up by your workspace, usually your computer and desk and some storage space. And I know that a lot of times we're just working with a laptop and it moves from place to place. For the purpose of this calculation, you have to sort of pretend that you have a place, just a set place where you do your work. And you look at that floor space and you compare it to the total floor space of your home. This creates a fraction, and you multiply your total overhead cost by that fraction. And that's how you come up with business use of home. Got a question here. Is there a minimum distance for how far outside your region you have to travel for 12 hours? Not really. In Toronto, we generally say just the GTA. So, I mean, it isn't really clearly defined. It really isn't clearly defined. I would say that if you're traveling by car, like for like half an hour, you're getting pretty far from home, I would say. But basically all they really say is the home region. This is another not very useful question. But basically, okay, so what they're thinking is that if you're essentially like close enough to home, you should be just bringing a lunch. Like you're just everybody has to eat. Everybody's supposed to be paying for their food out of their after-tax income. So at what point does this expense become an expense because of work? And they're saying that time alone won't do it. You have to also be far from home. Because if it's just time, you could just go home and eat and come back or something like that. So that's their reasoning. So if you think that you have a business expense that's an out-of-town business expense and you feel like it's kind of questionable, this is kind of what they're looking for, is that you kind of were too far from home to just go home and make a sandwich. So another question here. CRA looks at the length of time in a week you're using the space in the home, right? Well, it depends. If you have dedicated workspace, so a workspace that you use for your work and it does not become a personal space after hours. So if you work at the dining room table and then at night you take your computer away and you eat at the dining room table, now only certain hours are being used for business. And then what you have to do is further prorate your business use of home by how many of the hours in a week are used for business versus personal. If you have dedicated space where you have your work stuff and that is where you do your work and you don't do anything else there, then you don't have to prorate for the hours because it's basically all the hours. It is a dedicated workspace. But if it's not a dedicated workspace, if it switches tasks, then yeah, you're supposed to take into consideration how many hours, what fraction of your hours is this room used for business versus when does it revert to being your own space. So they can look at hours, but not necessarily if you have a dedicated space. Okay, so moving on, vehicle expenses, the process is really, really similar rather. You have the operational cost of the car, which includes things like gas, insurance, maintenance, repairs. All these are the costs that go into operating your car. There's also a certain amount of depreciation on your car. And then you make a fraction out of the kilometers that you drove for business compared to the kilometers that you drove overall. And so if it turns out that 1 in 10 kilometers that you put on the car was actually for business, then you get to take 1/10 of the operational costs and write them off as a vehicle expense. And there's also a certain amount of allowance for the depreciation. It's not really depreciation, it's amortization, but whatever. It's what you think of as depreciation of the car. And you also get to take a little percentage of it based on kilometers driven. So these are expenses that have really specific rules about them. But beyond that, there are literally an infinite number of things that you could potentially wonder if you can write off or not write off against your self-employment income. So when you get outside of these sort of known limits, you're dealing with expenses that maybe the Canada Revenue Agency has never thought of before, then you have to start to apply the CRA's own tax principle here. Because if you ever get reviewed or audited, it is the auditor is going to be applying this principle. So you have to know what it is so that you can apply it too. And you can argue with them on the same level, that you're arguing about the same thing. And that principle is the reasonable expectation of profit. So I'm going to quickly explain what this very important phrase means, reasonable expectation of profit. I'm going to go backwards one by one through the words. Profit. Profit only exists if the money that you earn exceeds the money you have to spend to earn that money. So you have a fee of $500. If your expenses exceed $500, then you don't have a profit. Okay, so making sure that the expense is less than the income it's supposed to earn for you or help you earn. Next is expectation. So it's the expectation of profit, meaning in the end, the expense may not have earned you what you wanted it to earn you. You may have actually spent more than it made for you. You may have spent money to get yourself listed in a certain directory, hoping it would get you the gigs, and it got you no gigs. So in fact, that expense exceeded the income generated. That's okay, as long as you had an expectation that it would make you more money than it cost you. So it was a good faith attempt to bring in more income. You write off the cost of that directory listing anyway. And the other thing is reasonable, that all of this has to be reasonable. So you have to expect profit, and that expectation has to be a reasonable expectation, an expectation of a reasonable person, not somebody, like in the throes of a cocaine high, right? Reasonable expectation of profit. So if you're ever being challenged on an expense, or if you're challenging yourself on whether you should deduct an expense, or in fact, if you are even deciding whether to spend money on your business, you're pondering whether to pay for that listing or purchase that extra gear, you should be applying this principle too, the principle of the reasonable expectation of profit, that you don't make a business purchase, or at least it's not a business purchase, if you did not have the reasonable expectation of profit. Now, deductions are one of those things that I have a whole bunch of resources on. I have a guide that's got a lot of information in it. It is written sort of from the perspective of a person who is involved more in the arts than in selling widgets or whatever. So it should be able to address questions that you might have about what can be deducted and what can't be deducted and where you put it all in a way that's sort of more sort of relates better to you than maybe the stuff that you can find on CRA's website. Now we're about to move on away from this question of business deductions. We have a little bit more to talk about that, but we're actually going to switch gears for a second, unless there are questions about what we've just talked about that you want to clear right now. Anyone? Okay, I think we can move on. And remember, if you think of a question later, we will circle back and have another little Q&A at the very end. So don't worry too much about it. Okay, the GST, HST. So just to be clear before I say anything at all about the GST and HST, I use the terms GST and HST interchangeably. They are essentially one tax, two forms of a single tax. It's just dealt with slightly differently in different provinces, but really the rules that I'm going to tell you about right now are identical for both GST and HST. So while I try to use both terms every time, sometimes I will just slide over and say either GST or HST. If you are thinking, oh, wait, but they don't have that tax in my province, it's GST, not HST, or in my province, it's HST, not GST, rest assured that whatever I'm talking about relates to both, in case I get lazy and start just referring to one. Okay, I see a couple of questions that popped up really about the section before, so I will quickly answer them. I mean, can instruments be counted as business deductions? Yes, of course, but there are expenses which are written off in their totality for the tax year, and there are capital assets which are written off gradually over the course of many years according to certain rules that the Canada Revenue Agency lays out. The rules about capital cost allowance, or CCA, are way too complicated to get into right now, but ultimately you will write off the cost of your instrument. You just don't write it all off in a single year. And just to quickly talk a little bit about principles here, the principle behind this is a principle that in accounting is called matching. And matching is where you try your best to match a business expense to the income that it helps you earn. So when you earn income in the year, you're writing off the expenses for that year. But when you purchase an instrument, that is a large expense in 1 year that you will probably not be buying another bassoon the next year, right? You will be using that bassoon for many years, and it will be helping you earn income for many years. And the rules around capital assets and capital cost allowance are designed so that you're writing off a little of the expense every year against the income that it helped you earn in that year. So because the income that your instrument is going to help you earn is spread out over many years, by the same token, the cost of that instrument is also spread out over many years using the rules that are called under the umbrella of capital cost allowance. There is a little bit of information in that booklet that is about deductions. There's a bit of information about how to define the difference between a capital asset and an expense. If you come to us to do your taxes, we take care of the rules about capital cost allowance, but you should really know what the difference is between an asset and an expense. And by the way, that link that I had up there, it will come up again. I'll put it up again elsewhere in the talk, and I'm also going to probably send it out through the chat. So don't worry if you missed it; it's coming back as well. Question: the deduction for self-improvement applicable to performing artists. Can you comment on this? So I assume that we're talking about taking additional lessons and training to become better at what you do. So this is a great time to apply that rule of, does it give you the reasonable expectation of profit? Does the amount that you are paying to your teacher or your coach or your instructor, is it likely to generate at least the same amount in additional income? Because you become better, is your income going to go up? And is the price that you paid to become better no larger than the amount of additional income that it's going to help you make? Now, because you're an artist, you are willing to pay for self-improvement that will not make you more money. You're willing to do it just to self-improve. And so what I would say there is you might want to consider writing off on your taxes only a portion. So you write off the portion, like how much extra income do you think this is really going to help you make? Don't write off more than that in the cost of coaching. These are all impossible estimates, by the way. These are all impossible to guess at. Essentially, whatever decision you make as to how much of your professional development expense you decide to write off, be prepared that if and when the Canada Revenue Agency ever reviews this, that you will be able to defend that you had a reasonable expectation of profit. Because ultimately, that is always a discussion that you're going to have in an audit. Either that you need proof because you're either going to be looking for supporting documents, or beyond that, if you do have the supporting documents proving that you paid it, but they're saying, yeah, you paid it, but why should you be allowed to write it off? The argument you're trying to make is that you had a reasonable expectation of profit. If you feel that you can make that argument, you're willing to make that argument, go ahead and write it off. You might not win, but go ahead and write it off. And before I go any further, a little note about audits, which everybody always wants to know about. The chances of getting audited are always quite small, but they are never zero. And it's a bit like the weather in that you don't have any control. You really have almost no control over whether or not you're going to get audited. There are certain things that you can do, like claiming a lot of losses, that can encourage an audit. But generally, if you're going along in your life, there's not much you can do. The audit is kind of random. It's going to happen or it's not going to happen. So basically, we try to teach you to take care of your stuff in such a way that you're always ready for the audit. It may never happen. It will probably never happen, but you're ready. And another thing to point out here is that if you've been writing off expenses all these years and you've never been audited, do not fall into the trap of believing that now CRA has approved of everything you've written off. It's not true. The CRA originally, when you file your return, takes your word for everything. It's an honor system. They just take your word for it. So until you've actually been audited and they've actually looked at those expenses, you don't know what they really think, right? They don't know exactly what you wrote off. What you file with the government is actually pretty broad strokes. They don't know. So just because you filed a return and you never heard back, that does not mean that you've been actively approved of by the government. It means that you've been passively ignored. So just be aware of that as well. Can the internet bill be considered as part of the business deduction? Yes, of course. I mean, without the internet, you can't make any money. We all know that realistically that is the case. Usually with our clients, we tell them to deduct no more than 50% of it because we all also use it for personal purposes. So yeah, write off maybe half your internet, but it's absolutely true that I don't know how you would in this day and age make a living without the internet. And therefore, as a person, you might decide to live like a monk and not have internet, but as a self-employed person, you know that that's suicide. Of course, you need to have, you have to have an internet connection. So I would say, yeah, write it off, write off part of it. Capital cost allowance would be great to get into if you can. I don't understand what that means, but it's a comment, not a question, so I'm going to move on. Okay, somebody would like me to break down the rules about capital cost allowance at the end. I'm not going to circle back. I'm going to actually break it down very quickly right now. You pay a certain amount for your instrument. You're allowed to write off a certain portion of it in the first year that you own it. So let's say we're just going to make the math easy. We're going to say that your instrument costs $1,000 and that the rules allow you to write off about $100 of that in the first year. Okay. So you have $1,000, you get to write off $100. Now there's $900 of cost that you have not written off yet. The next year, a calculation is applied to that. So let's say that you're allowed to write off 10% per year. This is not really accurate, but I'm just going to do it this way. So 10% per year. So you make your purchase $1,000. That year, you write off $100. You've still got $900 left. The next year, you can write off 10% of $900. So $90. You've got $810 left. The next year, you get to write off 10% of $810. This is where it's going to get hard. So you get to write off $81, which leaves you with hold on, 731, I think. No, 729. There you go, 729. And it goes on like that. So essentially what's left to write off kind of continually shrinks, but it never quite gets to zero, but it gets vanishingly small. And that's how capital cost allowance works. What category would music videos be deducted under? Advertising? This is a really interesting question. Really interesting. And I have a pseudo answer for you. It's not great. Yes, I would write it off under advertising. Now, what I will say is that outside of the expenses that have special rules, you know what, I'm going to go back just, you know what, I might as well post this because we're clearly not going to start talking about HST just yet. Outside of the items that have certain rules, all the other expenses can basically be, it doesn't really matter which category you use typically, because the expenses that don't have special rules, meals have special rules, capital cost allowance has special rules, business use of home has special rules, but everything else really doesn't. And mathematically, it doesn't matter where you put it, as long as you stay out of these special rule categories. So it doesn't really matter. On the other hand, and I will say that the Canada Revenue Agency, when you first file your return, doesn't see what you have written off for each category. They do not see the categories. Let me say that again. They don't see where you put your expenses. They just see your gross income and your net according to your calculations. They see nothing else unless they review you. So the process is that if If they have no particular reason or interest in reviewing you based on your gross and your net, this is all they will ever know of that year's taxes. If they decide, for whatever reason, which can have sometimes has nothing to do with what you filed, but just as because you're a musician and this year they're reviewing musicians, then they ask for the breakdown. Only when you're getting reviewed do they actually get the breakdown. And then they like to zoom in on certain things. And I'm sorry to say that advertising is one of them. So you want to, yes, there are advertising expenses. Of course there are, but you want to make sure, because advertising is a category where people tend to throw a lot of stuff like, well, I spent money on a very expensive vehicle because that makes me look better. And therefore, I had to get a two-tone sort of color shifting paint job on it. And I want to write that off because it helps me get gigs. It's advertising. So that kind of reasoning can be used by irresponsible people in very irresponsible ways. So I, on the one hand, would not really hesitate to write off a music video as advertising. But if you have a lot of other advertising expenses, maybe consider putting it somewhere else. Although I really don't know where else it would go. That would be my first guess, actually, advertising. Yeah. How many years back can CRA look back to audit a return? 7 years, and we're going to talk about that in more detail later on. I'm guessing auditions would be deductible, plane cost, hotel meals, etc. Does it matter if the jobs are out of country or out of province? Would they be treated the same way? Is it an expense that gives you a reasonable expectation of profit? Like you've been asked to audition and you expect to make much more money on the gig than it cost you to fly out there? Yeah. Auditions typically would be. Now, if you're going to spend, $13,000 on a first class ticket to audition in Berlin for a gig that's going to pay you $700, you do not have the reasonable expectation of profit. So consider. All right. But yeah, in general, yes, the cost to go to an audition, if as a business person, you would say, yeah, it's worth giving it a shot because I think I'm going to make my money back and more. I've got a decent chance of getting this gig and being paid more than it cost me to do this, then yes. When in doubt, particularly when it comes to travel, which we all enjoyed in the before times, when it comes to travel, be very careful about this. Always apply this reasonable expectation of profit rule. Think about it as if you have a twin who wants you to pay for this expense, and you will get your money back if and only if it pans out. Would you take that bet? Would you give them the money for that plane ticket, knowing what their chances are? And if you say, yeah, I would, then go ahead and do it for yourself, right? Try to step away from the situation yourself and try to think, would this be a good business decision? Not a good artistic decision, but a good business decision. Because when it comes to taxes, we are talking about the business aspect of your business as an artist, not the artist aspect of your business as an artist. So make sure it's a good business decision. By applying reasonable expectation of profit, you should be able to take guidance from that. Okay, if you purchased your instrument in a year where you weren't actively making money using it, this is an excellent question. Still a student, not a musician, can you claim it in a future year, or does it have to be in the year that you originally purchased it? I have a very clear answer for this. You get to treat this capital asset as a new purchase in the year that you begin your work, your professional work as a freelance musician. But you don't necessarily take it in at the purchase price. You have to take it in at the fair market value price, which is to say that if you purchased an instrument for $1,000 in your third year of university, and you played it for 2 years, and then you became a professional in the third year, you have to figure out what that instrument, a 2-year-old student level instrument or whatever level it was, would sell for. What could you sell this instrument for to a stranger at the moment that you became self-employed? And that becomes the purchase price when you do your tax calculation. Okay, the fair market value of when you have what's called a change of use. You have something that was personal. It's considered personal use while you're still a student, becomes business use once you become a professional. So It's changed in use from personal to business. And at the time of change of use, how much was it worth on the open market? That's how you do it. Subcontractors like session musicians, collaborators, visual artists, etc. Does that go under the expense category cost of goods? It can. You can go under, there's a section there, actually, there's a section in parts of the tax return that has room for a subcontractor. You can do that. But there's also a section called salaries, wages, and benefits. And I usually put subcontractors when we are doing a return for somebody who's like a band leader and they collect all the money from the payer and then they have to pay the musicians. We usually put the musicians down there in salaries, wages, and benefits. There's a place for it in the profit and loss form that you complete as a self-employed person when you're completing your tax return. Okay. GST, HST, which is the same thing. Let's define our terms. The GST is a goods and services tax. So it is a sales tax at the federal level charged on goods and services. So on money that changes hands because one person is passing over money in exchange for a good or a service. And there's a federal sales tax on that. PST is the provincial sales tax. Some provinces have a separate provincial sales tax and some don't. But PST is the provincial part, as a provincial sales tax. And some provinces have combined the federal sales tax with the provincial sales tax into a single tax with one set of rules, which is the HST. So the idea behind the HST is that it really cuts down on administrative headaches, because in provinces that have the GST and the PST, there are different rules for when you collect it, the form that you have to file to report it, the deadlines, how you report it. There are two sets of rules and you have to know them both if you're registered for both these taxes. But in a harmonized province, such as Ontario or the Atlantic provinces, there's only one tax and there's only one rule that apply, or one set of rules that applies to everything. So as you see, the GST is part of the HST, and that's why when I say HST or GST, I'm talking about the same thing, because they're subject to one set of rules. And finally, if I use the term supply, or if you see the word supply in anything that you, if you reference the Canada Revenue Agency's website and you see them talking about supply. Now you as a musician don't think of what you do as a supply, but it is, because in the realm of tax talk, the supply is either a good or a service. It's just whatever is being exchanged for money or other objects of value. So when you go and you play a gig and you get paid, that gig was a supply. You supplied it. So do you even have to concern yourself with the GST, HST system? Well, a lot of you know about the $30,000 rule, which I'll reiterate. If you earn $30,000 of freelance gross in a year, it's time to register for the GST, HST. So some refinements here. So only your self-employment income matters here. If you have a salary job on top of your self-employment, only the self-employment income counts toward this $30,000 limit. Second, it has to be earned within a 12-month period. That does not necessarily mean that it's confined to a calendar year. So for example, if you get two $15,000 gigs, one in December for Christmas and one in January for New Year's, and you're saying, well, it's $15,000 in one year, it's $15,000 in the other year, therefore I didn't cross the $30,000 limit. Yes, you did, because you crossed it in the space of 12 months, 12 consecutive months. The rule is actually a little more nuanced than that, but that's the basic rule. And because the 12-month period that we're talking about can span 2 calendar years, what this means is that you always, whatever point in time you're standing at right now, you have to look back over your shoulder 12 months and see if you cross that line. So at any given time, if you look back at your 12 months billing, did you cross the $30,000 line? Yes, then you must register for the GST, which means that you're going to call the Canada Revenue Agency, get a number, and start charging it. You do not have to go back. If it's time to charge, you don't have to go back and charge from before, okay? You cross the line when you pass that $30,000 mark. Then you register, and from that point forward, you charge GST or HST, depending on the province of the payer. You do not have to retroactively charge it or pay it or anything like that. Excellent question right here. Does private teaching count toward the $30,000 cutoff? And because you are musicians, you are talking about music lessons, which is very specific. Music lessons are one of the few things in the world that the Canada Revenue Agency considers to be exempt from the GST HST system. Exempt. And by exempt, we mean no, they do not count toward the $30,000 limit. We will be talking a little bit more about special kinds of income and what counts and what doesn't count, but music lessons do not count toward the $30,000. Specifically music lessons. If you taught anything else, like, you know, you're here because you're orchestral players. If by some chance, I don't know, if you're teaching, I don't know, bookbinding or something, that actually is not exempt. Only music lessons. So anything other than music lessons, teaching any kind of teaching other than music lessons does count toward the $30,000, but music lessons don't. So I'm going to explain the entire GST HST system in a single slide. And here it is. Once you become a registrant, you become part of the GST HST system. At that point, you must start charging it. The amounts that you charge to your payers are not yours. The GST or HST that you add on top of your fee does not belong to you. It is a tax that you have collected on behalf of the government, and it belongs to the government, and ultimately you're going to send it to the government. On the other hand, if you're living and working in Canada, chances are the expenses that you're spending on your business also include GST or HST. When you bought your instrument, there was GST or HST on it if you bought it here in Canada. That GST and HST, which you used to just write off, now instead of writing it off, you're going to get it back, which is better. Trust me, mathematically, it's better. So this is the way it works. Being registered for the GST means, first of all, that the GST is added on top of your fees and collected from the payer. And second of all, that the GST that used to be embedded in your expenses is now going to be separated out and collected back from the government. So I see a question here. I'm going to see if now's the time to answer it or if I'm going to answer it a little bit later. All right. Okay. I've been a GST registrant for several years now, but as I've been getting closer to approaching retirement, I don't make anywhere near $30,000 per year, and I never will again. Is there an advantage or disadvantage to deregistering, becoming a non-GST dude? Can one ever even do that? Okay. In a moment, I'm going to explain why there is always a financial benefit to being registered. There is a financial advantage to being registered. However, the less money you earn and the less money you spend on your business, the smaller that advantage gets. So only you can really judge if it's worth it. Depends on how much you hate paperwork, really. And the other thing to consider is, now when you are being paid by an entity, generally they are also registered for the GST, which means on their end that if you charge them GST, they are going to claim it back from the government. And therefore, when you're billing an entity, they don't care if you're charging HST on top of your fee, because they know that it's not actually coming out of their pocket. They're going to get it back. But when you are charging an individual, like you're working a wedding or a funeral, and it's a person who's hiring you, you have to charge the GST and HST to them too if you're registered. And that automatically makes you more expensive than a non-registered musician. So if you are dealing directly with individuals, there may really be a disadvantage to being GST registered. And if you don't have to be, you might consider, closing your account. On the other hand, if that's not the case, if generally you are paid by entities, or that the people who pay you want you regardless of GST or not GST, you're not competing on price because that's not the way you roll. So there's no disadvantage in that case for you being registered. You are at a financial advantage to be registered. And here is why. When you're not registered, you basically bill your fees, and out of your fees, you pay your business expenses. Those are gone, and what's left over is your profit. Done. When you're registered, you have your fees, you're billing GST or HST on top of those fees, and you are spending GST inside of your expenses, right? Because you always have to, when you go to Staples, you have to pay them the GST up front. It's embedded in your costs. So when it's time to file your return with your GST people, you are going to, well, okay, so there you've spent your money on your expenses and your GST. You give the government the GST that you collected on top of your expenses, and they give you back the GST that you spent on your expenses. Sorry, you give them what you collected on top of your fees, they give you back what you spent on your expenses, and that becomes your profit. So the profit is a little bit bigger if you are registered. And this is mathematically always the case, because the amount that you remit to the government is always an amount that you collected straight from the client. It's not your money, it's their money. And meanwhile, the money you get back is the money that you had to spend on your expenses and you would have spent either way, only now you get it back because you're registered. So you have to, if you're deciding whether to register or deregister, if you don't make the 30,000 and you're trying to decide what's better, you really have to decide how much, income am I potentially losing because I'm registered and individuals don't want to pay this GST because they don't get it back, versus how much am I getting because I get to write it off and claim it back on my expenses. So the financial decision is in there, tempered a little by how much do you hate filing your GST return. Because as long as you're registered, you must be filing GST returns on a regular basis. Even if you make no money, if you're still registered, you have to file a nil return. You have to keep the government informed of what you're doing with your GST once you're registered until you close that account. So there's always paperwork involved. Excellent question here. Do you get your GST back on CCA items? GST, PST back on CCA items. I don't know about how the PST works in your province. Yes, you get the GST back. And if you're in a harmonized province, yes, you get the HST back. And unlike the expense, the underlying expense that is spread out over years, you get it back right away. You get it back in the year that you spend it. So let's say that you're here in Ontario, you spend $1,000 on an instrument, they charge you $1,130 because you're paying 13% HST. In the year, you will get the $130 of GST, HST back on your GST account. And then what's left is still the underlying cost of the instrument, and that you're going to write off gradually. Whereas if you were not registered, you'd have an expense of $1,130. You would get to write off the whole thing, but that is not, it doesn't actually do as much good for you as claiming back all the HST. Okay. Thank you. You're welcome. Does a GST registrant need to keep track of and declare the actual GST portion of claimed expenses, or is it simply calculated by the CRA on the total expense amount? Yes, you have to calculate it. Yes, you have to calculate it, because you may have purchased something that doesn't have any GST because you bought it in the States. You may have purchased something in another province where they charge GST when you live in an HST province, or they charge HST when you live in a GST province. There is no way for the government to know, just looking at your expenses, how much you spent on GST and HST. It is your responsibility to keep those separate. That said, here at Personal Tax Advisors, because a GST registrant, in order to accurately even report your income tax correctly, we must make sure that the GST and HST is not interfering. And so we have to split it out. We do that as part of the process. And because we do that as part of the process, we actually calculate and file your HST, GST return free of charge. Like if you come to us for self-employment, we're doing the same calculation anyway. We just throw in the GST return for free. And we do it with math generally. But just so you know, yeah, we split things out, or we, with your help, your information, we split things out for you. And we put the amounts that belong on the GST return on the GST return, and the amounts that belong on the income tax return on the income tax return, because they shouldn't really, generally, they don't cross over. Sorry, I answered that. Can you speak about the quick method for calculating GST, HST? Nobody has ever asked me this. The quick method is actually not quick from the perspective of me, your friendly neighborhood tax preparer, because it's a pain in the butt. But basically the way the quick method works is, you, instead of keeping your GST and your HST separate, you actually, and instead of claiming back the GST or the HST on your expenses, what you do is you take the full amount that you billed, you ignore your expenses, the full amount that you billed, and you give a percentage to the government. The percentage is set by the government. So what they've done is they've looked at many, many businesses, and they figured out generally how income to expense ratios tend to fall out. And they've sort of just calculated for you. Yeah, you'd probably, on that income, doing what you do, you'd probably have to give us 8.8%. So give us 8.8%. And that's the quick method. There's a little more nuance there, a little bit more, but it's, for me to explain it with no charts would be so confusing to people who aren't really doing it. That's the thing. One thing about the quick method is, if you want to use the quick method, like you're doing your own taxes, it is a simpler calculation slightly. If you're just doing broad strokes and you're doing your own taxes, maybe you have to elect for it, which is to say that by default, you're not on the system, you're not allowed to use it. You fill out a little, it's not even an application, it's just I want to go on the quick method. You can go through my business account, or you can call CRA and just switch, and they will set you up as quick method, and then you file as quick method for at least 1 year. If you don't like it, you can switch back, but anytime you make a switch from the quick method to the long, or from the long to the quick, you have to stay on it for a year before you can change back. I hope that answered what you wanted to know. Okay. I just moved to Quebec. I used to live in Ontario. I remember HST filing was quite simple. Do I now have to file the QST and GST separately? Oh dear. It depends on whether or not, and this requires no knowledge of a provincial sales tax. I am an income tax person, and therefore, and a federal tax person mostly. So provincial sales tax is where I am not 100% versed on exactly the rules. So I'm not going to get precise about the rules. If under the Quebec rules, you must charge Quebec provincial tax, because it's separate. Everything about Quebec is separate. Then you may have to file a separate return for that. I don't really know what their rules are about the sales tax, but generally, most people are just filing a single return. And I think the QST return is actually the only return that just combines, your PST and your GST. It's so weird the way they calculate the GST there as well. I'm sorry, this is just one of those things where I think you're going to have to ask them, and ask them in French if you can, because anyway, if it's a separate sales tax, they might have a separate filing thing. But I don't actually think that they do. I think they actually have combined it into a single form, but it's still two calculations. You end up having to keep both figures completely separate, because I actually do work these numbers for a client of mine, and come to think of it, no, they are separate returns. Yep, they are separate returns. I have done this. They are separate returns. They look the same, and like they're laid out the same, and all it's changed is that the box number on the GST is 101, and the box number on the QST return is 201. But they're different, because some things have GST and not QST, and some things that you purchase in another province have neither. And they're separate returns. We also calculate those on the fly when we do this. So I'm sorry, it's not as simple. It is still, the process is the same, but it's two. You got to do it twice with two sets of numbers. Do I need to change my common law partner HST? We work together and supply services to each other. Do I need to charge it? Sorry, do I need to charge it? We work together and supply services to each other. If you have semi-formalized this process of paying your partner for something, so that you are writing off that cost in your income tax return, and they are declaring that income on their return, then yeah, she has to charge you, or he or she has to charge you GST or HST, depending on the province that you're in, and you have to pay it and claim it back. And but there are a lot of situations where partners who are exchanging services don't, if you are writing off the cost, they must declare the income. If If she's not declaring the income, then you can't write off the cost. So if you're doing it informally, nobody's reporting anything, then no, you don't have to do the GST. But if you're doing it formally, that she is declaring the income and you are writing off the cost, then yeah, HST must be charged. There's no special rule that says you don't charge it to your spouse. Okay, another question. When I registered for the GST, they asked me if I wanted to file annually or quarterly, and the agent I spoke to said there was no difference. Do you have any insight as to whether one might make one better than the other? Yes, annually is better. I'll tell you why. The filing period is how often you have to basically send the government a report as to what you're doing with your HST. To me, filing quarterly is just doing this job 4 times when you could just do it once. Now, a lot of people think that if they file quarterly, that means that they're avoiding a problem of having the GST or HST that they're collecting kind of pile up and they don't know what's theirs anymore and so on. Well, for one thing, and we'll talk a bit later about this if we get that far, you should be setting that money aside anyway. Like any GST or HST you collect, you should be setting aside anyway. It shouldn't really matter. Second of all, filing is not the same as paying. Filing is just reporting to the government what you're doing. Filing that return generates a tax bill, which you then pay. So in terms of what you're going to remit in GST, it's exactly the same. Basically, if you file quarterly, you have essentially one quarter sort of your figures are on one return, and then another quarter on another return, and another quarter on another return, and another quarter on another return. 4 pieces of paper you have to file, 4 deadlines you have to be aware of, 4 times you have to stop and do this calculation, as opposed to annually. 1 deadline that you have to know, 1 piece of paper you have to file, 1 calculation that you need to do. So I really think annual is better. Basically, the way it goes is that the more money you make, the more frequently they want to hear from you. If you make there is a point where you must file quarterly or more often, and that is a point where your revenues exceed $1.5 million. At that point, they're going to want to hear from you quarterly. But as long as you're not making $1.5 million, go ahead, opt for the annual and file once a year. And the other nice thing about the annual is the quarterly ones are due at in April, and then another one is due in July, and then another one is due in September, and then another one is due in January. If you file annually and you are a sole proprietor, meaning you're not a partner and you're not a corporation, it's just you, the GST return, the annual return, is due exactly the same day as your tax return. Easy. That's one less thing to remember. So annual, better. Is it legal to pay your spouse informally? Yeah, it's called like giving them some money. I pay my spouse informally all the time. Every time he runs out of money, I pay him informally. Yeah, of course it is. What's not legal is for you to write it off and her to not declare it as income. That you get a tax break for paying her, but she doesn't pay the tax burden for doing the work. So the rule when you're paying a spouse or a dependent child, anybody that you're related to, the rule is that you must pay them an amount. Like if you're actually gonna write it off on your taxes and have them declare it as income or whatever, there can be tax advantages to this, particularly if the other person doesn't make any money other than what you pay them. It can help you spread out income. It can be useful, but you're not allowed to pay them an amount that's higher than what you would pay a stranger to do the same job. So make sure that you have a little note indicating if you are paying them and you're writing it off and they're declaring it as income, make sure that the amount that you are paying them makes sense and that you have a little calculation where you show that it makes sense, and you're going to hang on to that in case CRA ever asks to see it. We'll talk about records in a little bit. Okay. Done. All right. If you are doing, back to the HST, if you are doing some work for a payer who is not here, so you're going to be doing some work for a gig in Berlin or in the US or whatever, how does it work if you're HST registered? Well, first of all, you don't charge them the HST. They are called 0 rated. You don't charge it to them. However, on the upside, you still get to claim back the GST on the expenses relating to that work. So if you decide to play a gig in Philadelphia, you are not charging them HST. And if you take the train to Philadelphia and there was $100 of GST or HST on that train ticket, you still get to claim back that GST or HST And so you remit, on this particular job, you would remit 0, but claim back $100 of GST. So you'd actually end up with a refund of GST based on this, based on working for a client who's not in Canada. You charge GST or HST to Canadian payers and Canadian payers only, and you pay, and the rate that you charge them is not the rate in your province, it's the rate in their province. I'll say that again. When you are performing a service for somebody, even if your butt is still at home, you charge according to where the payer is located. Okay. And in the case of an American or European payer, they are located outside of Canada. So you charge them what they're supposed to pay, which is nothing. Music lessons are exempt. Hey, so we've already been through this. You don't charge HST on them, but you cannot claim back the HST that is related to expenses that are just for music lessons. So you have a smaller profit on that one. So it's kind of like, yeah, that shouldn't have come back to you because that's not the way that works. Okay. Now, what if you just don't want to be registered? You're not making $30,000, you don't have to, and you don't want to because you don't want to do the paperwork, or you are over $30,000 and you know you should be registering, but you don't want to. I will give you a warning: if you are over $30,000 and you don't register, nothing will happen at first. Eventually, the Canada Revenue Agency takes a look at your income tax returns, sees that you are grossing over $30,000, notes that there is no associated GST account, and wants to know why. And if the reason is that you just didn't feel like registering, you're in trouble, because what they will do is they will back register you. Maybe 3 years back, I've seen this happen. They go and say, okay, you should have registered in 2018. And we want all the GST that you were supposed to be collecting all that time, please hand it over. People are always asking me about how not to get audited, and they're always concerned about this. They're not as concerned about the fact that they don't register for the HST when they should. While the timing, the exact timing, there are rules about exactly when you have to register for the HST, but the exact timing isn't really the issue. Just register when you're in the ballpark before they notice. So you can be a little late registering as long as you notice that you should have registered before the Canada Revenue Agency notices that you should have registered. So if you are over 30,000, absolutely register the second that you notice that. Register. It doesn't matter that you're 2 years late. CRA hasn't noticed yet. A year from now, they might notice. But if you've already registered, by the time they notice, they'll leave you alone. Now, if you're under 30,000, so you don't have to register, and you don't want to register, let's say, okay, fair enough. But one thing I'm going to point out about this, there are two advantages to being registered, whether you need to or not. The first, register, we've discussed. There's a financial advantage to being registered. The second advantage is nobody knows how much you bill. Sorry. Because the problem is that any payer in Canada who's like an entity, like a company, they know that the $30,000 rule is in force. And when you issue an invoice, if you are registered for the HST or the GST, you have to put your HST or GST number on the invoice, and you have to show the HST or GST that you're charging on its own line. In other words, an invoice from a registered person is visually obviously different from one from a non-registered person. So anybody looking at your invoice immediately knows whether you're registered or not. If you're not registered, they can infer from that you don't make $30,000 freelance, and that may be something you don't want them to know. So if it's none of their business, or if you think that it's going to hurt you in some way for them to realize that you're, not making $30,000 self-employed, you can hide that by being registered. So that's another thing to take into consideration. Now, I do have a great resource about this, a primer that it's about 10 pages long, and at least one of those pages is just charts. So it's not a whole lot of text, and it's not closely written or anything. It's just a quick lickety-split handbook. And it'll tell you kind of everything that you need to know for the GST pretty much for your whole career. There's like almost impossible for you doing what you do to encounter an issue that isn't covered in this little booklet. So it's really a great little resource to have handy. And I'm going to add the I'm gonna put the link right in the chat. I see that there's a question in the chat too, which I will address in a moment. So there's a question in the chat, which is, should private music teaching income be declared separately from performing income? Should I fill out separate T2125 forms? That is the profit and loss statement that goes inside your tax return for each. No, you can put it all on the same T2125. You can put it all as part of your self-employment income. It just doesn't trigger an obligation to register for the HST. And it doesn't affect your HST collected or anything like that. It doesn't affect anything, but it does not have to be separated out. These are really two different returns, and it's just these two kinds of returns treat this income differently. If you make $30,000 across multiple income sources, not including music teaching, does that still qualify to register? If all those sources are self-employment, yes. As a sole proprietor, you and the work that you do for freelance pay are a single entity. It doesn't matter how many different types of things that you do. It's still, you are in the business of being you and selling your services. If you are selling your services for more than $30,000 per year, not counting music lessons, anywhere in the world, if it's freelance $30,000, yes, it all counts toward that $30,000 limit. Do I have another question about the GST before we move on? Okay. Again, we may have time. I'm prepared to go until 4:30 here. So, I mean, I'm sorry. I'm going to try to finish before that, but lately it hasn't really worked out that way. So, I will try to finish the slides before 4:30, and then we'll finish up with some Q&A if there's anything that's been missed or forgotten. Let's talk very, very briefly about special kinds of income. One is income outside of Canada, which we have actually already discussed. Income outside of Canada is taxable on your Canadian return. It is part of the $30,000 GST limit. It counts toward that limit. But it is like being paid by an American. It is zero rated. You don't charge them the HST, and you can claim back the GST or HST on expenses related to that income. If you work for an American payer, they may ask you to complete a form called the W-8 Go ahead and do that. What the W-8 does is the payer in the US may be obliged to withhold US taxes against your income that they pay you unless they have the W-8 So the W-8 is essentially, it's actually, when you break it down, if you look at the form and really read what it's asking for, it's a very simple form that essentially has who are you and where do you live and why do you not have to pay taxes in the States, which you would say, because I'm not an American citizen and I don't live in the United States. So that's what the W-8 states. And what it does for the payer is it gives them the right to not withhold US tax on your income. And that's what you want. Trust me, you will, even though we're not supposed to have double taxation, the way that the mathematics tends to work out, and certainly the way the administration works out, is it does cost a little bit more if a foreign country is withholding tax and you're filing Canadian taxes. It's not supposed to, and it's not a ton, but it's there. It's a little more expensive if you do it that way. So if at all possible, you want your foreign payers to not withhold any tax for you. The W-8 is what will allow that to happen, at least with your American payers. Okay, I see. There's a question regarding exactly this. Is there a way to get tax withholding back from American gigs? Usually they take 38% even with the W-8 They're really not supposed to. The whole purpose of the W-8 is to state that you pay taxes in a foreign country with whom the Americans have a treaty, and therefore they don't have to withhold tax. If they are asking for a W-8 and withholding tax, they don't know what they're doing. That said, short of actually filing an American tax return, which is going to be expensive and onerous, the way that you get your money back, you don't quite, is on your Canadian return, you make what's called a foreign tax credit claim, or we call it an FTC. So there's a schedule that you can add to your return that basically says, I made this much money in the US, this much tax was withheld. I would like a credit for that. I would like my Canadian taxes reduced to make up for that. And this is the process by which we mostly avoid double taxation. that you get to say, I already paid this tax in a treaty country. And the CRA says, okay, we'll reduce your income tax. The problem is it's usually not a dollar for dollar, and the CRA is stingy. So maybe they withheld $300. You file your FTC claim, you say they withheld $300, and CRA says, okay, we'll give you credit for 250 of that. You still have to pay the extra 50. So you're basically getting taxed a little bit more. So this is why the ideal situation is just to not have them withhold any tax, because while you can get a credit for the tax withheld, it's never quite dollar for dollar. In my experience, it's never quite worked out that way. Supposed to, but mathematically it's set to err on the side of caution, and you end up paying a little more tax. If a venue doesn't send you a W-8 Ben, can you just send them one so they don't take the withholding? I would say ask them if they know how to handle it, because if you're dealing with a venue or an entity that doesn't understand this stuff, you can send them the form, but they're not going to do anything with it. So ask them. Ask them, would it help? Like, are you planning to withhold U.S. tax? If yes, would it help if I gave you a W-8 Ben? Would you, would you just not do that, please? And see what they say, because you might be filling out a form for no point, to no purpose. All right. What if you lived? Okay, another question. What if you lived in the U.S. for a couple of months while gigging there? It depends on where your home base is. I'm hoping that your home base stayed here in Canada. If your home base is in Canada and you are temporarily living in another place in order to do a gig, you are still considered to be a tax resident of Canada. Residency rules can be really complicated, but they boil down to, where is your home base? They include things like, where are you physically? But they also include things like, where is your home? Where is your stuff? Where do you have where's your driver's license made out to? Where's your library card made out to, right? There's a bunch of little things that sort of establish where your home base is. So essentially, if you move to the US, you didn't pick up and move kind of your whole life. You just sort of domiciled there. You just sort of sojourned there for a while, and it was for less than 6 months. You're just going to file your Canadian tax return as usual. And I'm hoping that the Americans did not withhold your tax on that income. Briefly, we're going to talk a little bit about grants. The most important thing to remember about grants is there's several important things to remember about grants. One is that if you're using software to do your taxes and you have a T4A from the Canada Council with income in box 105 for your grant, the software is going to throw that on line 13,000, 13000, other income. That's where the software is going to automatically slot it, but you have another option, and I want you to take it. The other option is you put it as part of your self-employment gross. You remove it from other income and you place it on the profit and loss statement T2125. The reasons are multiple. One is because if the grant is a project grant, so it's designed to cover the expenses for a project. In other words, it's meant to be completely used up. You need to be able to write off those expenses against that grant income so that you don't ultimately pay any tax on that grant, right? If the grant was for $4,000 and your expenses were $4,000, if you leave the grant on line 130, you're going to pay tax on $3,500 anyway. You don't want to. You want to be able to write off the full expenses. You can't write off expenses against income that isn't showing up on that same form. So in order to write off the grant expenses, you must put the grant income on your self-employment statement. And that will ultimately mathematically work out so that you're going to pay less tax on it. And second of all, if there is any of this grant that you're actually getting to hold on to. So for example, the grant had a living allowance in there, or the expenses of the grant didn't actually meet the cost of the grant, so you ended up keeping some and it's taxable. It'll count as being pensionable as well. It's treated, by moving it to your self-employment income, it's treated as part of your business. And that has a couple of effects, one being that you get to write off your expenses, and the other one being that you get to contribute to the Canada Pension Plan, which at this moment, you may not want to do that because it's extra money out of your pocket. But When you retire, the amount of pension that you get from the Canada Pension Plan really is related to how much you've paid in. And you will get more from the pension plan than you have paid in. So you really want to pay into it if you have a chance. Especially in the modern day and doing what we do, you may not have any other pension other than the Canada Pension Plan. So you want to contribute to that pension plan. And by moving this income over to your self-employment, you get to do that. So I really want you to put it there. Take it off of other employment, put it onto your self-employment, please. Also, it's not actually, it's not actually subject to the GST or HST either. Remember that we said that the goods and services tax is for the exchange of goods or services in exchange for money. A grant doesn't have that exchange, right? They give you the money, they don't actually get what you produce. They don't own it, you know? If they give you the money to produce a concert, they don't own the concert. They don't get anything out of the concert. They don't even get the proceeds from the concert. So it is not actually the exchange of a good or a service, and therefore it's not part of the GST system. It's actually exempt. Being exempt, it's like music lessons. There's no GST included in that grant amount or added on top of it. It's completely separate. But in theory, the expenses relating to executing that grant, you cannot claim back the GST on those expenses, only on the expenses that relate to your GST taxable income. Cash payments are taxable. They must be reported, and they must also, if you are registered for the HST, whatever you collected in cash must be treated as if it also contains a certain amount of GST or HST based on your percentage. So you will not, so if you get paid, again, for simplicity's sake, let's say you get paid $100 for a gig and you are in Ontario and you're registered for the HST. If you got paid $100, you do not have to give them $13 on top of that back to the government. But you will split that $100 into about $88.75 plus $11.25, I think is how it works out, where it's $88.75 plus HST. So the amounts will be split of the cash amount, so that you'll end up reporting part. You use math to end up reporting part of the income as income and part as HST that you're going to remit to the government. There's another, yeah, so that's just gone from you. Yeah, so that's how cash payments are treated. Any other questions before we move on to the question of setting aside money for tax? Anything? Okay. All right, so setting aside money for tax. The best we can do is an estimate, because how much money you're actually going to owe in tax depends not only on how much money you're billing people, but also how much money you are spending on your business. And that can really vary a lot from business to business. That said, we generally advise people to take the money that they earn, like when you get paid, that's the easiest time to set money aside, is when you just got the money. So before you put it into your pot to spend it, we recommend that you set aside 15 to 20% of it as a starting point, and just set it somewhere else in preparation for taxes. This will not necessarily be enough. It might be too much, it might be not quite enough, but it should be in the ballpark. You shouldn't find it, if you've set aside between 15 and 20% and it turns out that it's not really enough, the extra that you owe should be a manageable amount. It should not be too out of line. As for where to set it aside, we think in terms of psychology, and that it's really hard to not spend what you can see right in front of you. So we recommend that you put it somewhere where it's a little bit harder to get at. I often say just like online banking is a great option, because it's not where you store the money that you actually use to buy stuff. It's not as visible to you. And even if you do want to use it for something, it kind of takes a couple of days to get it moved over. So it's just a little bit out of reach. You know, putting it inside an account like that is a bit like putting the cookies on the top shelf, just a little bit out of reach, so that you don't spend the money that you are setting aside for taxes. And by the way, remember that the first amount you set aside for taxes is a GST or HST that you collected on your fees. First, set that aside. You're now left with just the fees. And of those fees, you're going to set aside 15 to 20%. Now I see a question here. My preparer is old school and requires to meet physically, but I don't want to go to his office right now because of COVID. So I'm thinking of delaying my taxes until vaccinations. Aside from a fine of 10%, is there anything else I should worry about? I'm a USCA dual citizen. My sympathies. Being a US citizen is a nightmare. I need to use a specific cross-border accountant. Okay. Let me think for 1 second here. So first of all, it's only a fine of 10%. So the fine for late filing is 5% for the first day that you're late, plus an additional 1% for each additional month that you're late to a certain maximum. And we're going to go into a little more detail about that. So anybody who's wondering about those numbers, just hang on. We will talk about that. So the fine would be 10% if you've waited. So if you're like 6 months late, I guess, if that's the plan. You know, you could maybe avoid. So the fine that you pay when you're late filing is based on how much tax you owe. So what you could do, if you have an idea of how much tax you're going to owe, is go and pay an installment right now. And make sure it goes into your installment account for 2020. This may require making an installment payment and calling CRA to make sure that it's in the right account. Do it before April 30th. Because essentially that installment account will be applied against your tax bill whenever you file. If you've already paid your taxes, there's no fine. So if you have an idea of what you're going to owe, and remember that if you overestimate, if you pay an installment that you think is what you're going to owe and it turns out to be too much, you're going to get a refund. So go ahead and do it. So one thing I would say, if you don't want to pay that fine and you've got the money for your taxes, give it to the government right now. Make sure that you are paying it into the correct account. If you put it in the wrong account, not the end of the world, but you're going to have to do a little bit of jigging around to get it moved because you're going to have to call CRA and ask them to move it. It's a bit of a pain. So make sure that it's not a payment on filing, not a prior year's owing, that's for old tax bills, not an installment for 2021. You're going to try to get in one last installment for 2020. If you make a regular installment of payment, it is probably going to go into installment for 2021. So you're going to have to follow up with CRA, confirm where it went, and say you want it moved to 2020. And that way it will actually carry right through. You will owe little or nothing when you finally do file that tax return, and there will be little or no fine. So that's what I really recommend. Is prize money from competition treated the same as grants? Yeah, pretty much. I mean, obviously, they give you the prize money. They don't get anything in return from you other than, I guess the happy feeling of a job well done. So yeah, it's treated like grants. Do you need to keep the GST amount and the amount you set aside for taxes in separate places? No, you don't. I mean, we're just talking about money that is not going to stay with you. So just throw it all in one pot. That's fine. When all is said and done, if your estimates have been decent, and your record keeping has been decent, you're going to find that the two bills that you get, one bill from GST people and one bill from the income tax people, and you're going to find that you have the money for it. That's the purpose of setting it aside, right? You're not setting it aside to make something easier for CRA or anything like that. You're just setting it aside so that you don't spend it. So it can all be in the same place. Put it in a pillowcase if you want. Doesn't really matter. How do you make sure it's the right amount? Well, if you start with an estimate of 15 to 20%, and then you file your taxes and see how close you got. And then next year you change your set aside amount for your best possible guess. So we don't know. There is no way to be sure until you file your taxes. That is when you find out exactly how wrong you were. If you're worried about owing, set aside a little too much. If you're worried about day-to-day living, you can start with a bare minimum of 15%, but I will say that if you owe tax at the end of the year and you haven't set enough aside, or worse, if you haven't set anything aside, as hard as it may be to set anything aside, especially in a low income year, I promise that finding the tax money at the end of the year is harder. And I mean that, and I'm not being moralistic here, I'm being realistic. It is, if you are having trouble setting aside the 15% or the 20, I'd really prefer you to do 20. If you're having trouble doing that because it's hard to manage your money, it does not get easier if you wait. So I will just say that. Oh, how do you make sure it's the right account? Sorry, I answered the wrong question there. How do I, hold on, sorry. I read that wrong because I'm getting sleepy. How do you make sure it's the right account? If there is no right account, the right account is whatever account will let you put your money somewhere where you don't spend it. For some people just leave it in their main account and they're just aware of exactly how much money there doesn't belong to them. But that is asking for a lot of mental energy and a lot of sort of on the fly math constantly that I think is just too hard. So I think just set it in a separate account just so that you don't have to think about it again until it's time to hand it over. Is it a good idea to set money aside in an account that's making you interest? Yep, absolutely. So there's a question with a quote here. Toronto Arts Council, TO Artist COVID-19 Response Fund. They've sent an email saying, Toronto Arts Council has been advised by CRA that funds issued under this program do not constitute earned income, but are considered a windfall. Oh dear. For this reason, TAC will not be issuing a T4A to you for this support. There's no requirement to include this funding in your 2020 income tax return. That sounds to me like a special rule for 2020. It's a COVID-19 thing. And I think the main purpose behind it is to prevent you from having to repay part of your CERB benefit when you really shouldn't have to. So that is a really useful thing to know. It's not necessary to declare it within the freelance income. That seems to be what they're saying. Yeah, there may be a specific place to put a windfall, but it's not there. But yeah, there you go. But I would also say that any grants, any expenses that were actually covered by that grant, don't write them off as a business expense either. You're supposed to write off expenses against the income that you're getting taxed on. If the income is not being reported, it's not being taxed, then you can't write off the expenses for that income either. So just be aware of that. It looks like this is specifically saying do not report it on your tax return, or at least don't report it as earned income. If that is the case, also do not write off the expenses relating to it because you can't. For the same reason, funds issued under the TO Artist COVID-19 Response Fund cannot be considered income for the purposes of eligibility under the Canada Recovery Benefit Program. That was from 2019. And this is only to the specific response fund. Okay, so the response fund, I think, was a helper fund, not really a project grant fund. So it sounds like the project grants are still being reported the usual way. It's just this COVID response fund, which sounds like it was sort of an intended a helper fund, not a grant. So not a grant for artists. So yeah, the grants are the typical grant. The special recovery fund is treated differently. Very useful. Okay. Okay, you're very welcome. How bad can CRA fines get on an audit? Can it be like crippling? Yeah. Okay, so here's the way an audit works. Hi, thank you. I'm glad you're enjoying the presentation. The audit works is, or they call it a review. They will ask for some details about the things that you have chosen to write off. And where things get expensive is if they decide to disallow some of your expenses. In other words, that they don't agree that they're legitimate. And then it starts to cost money. Now, it's different cost of money depending on why, on what CRA, there's a subcategory here. There's disallowed because they think that you made a judgment call that they don't really agree with, right? And what that does is the expense, instead of being able to deduct it, it gets put back on your return so that that income that you wrote off gets put back on your return. So if it's a $2,000 expense that has now been disallowed, your expenses are now dropping by $2,000, which means that your net profit is increasing by that $2,000. So you're going to pay the tax on the $2,000. So is that going to become crippling? It depends literally on the size of the deductions that they are disallowing. So if they disallow enough expenses, then the tax that is triggered by that can be crippling. So the amount of tax that is triggered is the same amount of tax that you would have paid on the income if you had not written off that expense. Most things are being taxed. Most things, if you're not in the sort of $150,000 and up income bracket, Basically, you can assume that you're being taxed about 30% on income. So when you have an expense, you're going to get back in tax about 30% of that, because your income is going to drop by that amount and the relief is 30% tax. If an expense gets removed, so now the income is coming back into your return, 30%, that's tax. That's if they think that they don't agree that you should have written it off, but that it was basically a judgment call. They just don't think you should have made it. It's a correction. They've corrected your taxes. The tax bill is now what it would have been without the expense. The other kind of correction is where they think that you intentionally, willfully, knowingly were trying to cheat. And that is tax evasion. And with that, yeah, they put it back on. Yeah, you pay the tax, and then you pay the tax at least one more time. They double the tax. So let's say that you wrote off the $2,000, and they think not only should you not have written it off, you knew you shouldn't have written it off. You were cheating. You wrote off something that wasn't really a business expense. You wrote it off because you wanted to. Then they will put it back on your income. It'll trigger a tax bill, and they will double that tax bill. So it can be, again, it depends on both size and intention of the thing that they're disallowing in the audit. Assuming they disallow it. If you have fabulous records, if you keep fabulous records, and you can defend everything, and if you can successfully apply the principle of reasonable expectation of profit, you won't lose any of your expenses. I literally know somebody who got audited and basically came out exactly the same. They didn't charge her anything because she just defended herself perfectly. So that is also possible. I live in Quebec and received some income from an organization based outside of Quebec for which I received a T4A, but not a Quebec tax slip. Would this mean that this type of income is not taxable in Quebec, or that I have to add it manually to the provincial return? If it's relevant, it would fall under the category of scholarship/award. Yes, you must manually report it on your Quebec return. If you use software and it does a slip download, slips coming in directly from the Canada Revenue Agency, the T4A is there. It's going to get pulled into your return. And depending on the software, it should automatically show up on your Quebec return as well. So there, yeah, it's all taxable according to Quebec's rules. So whatever Quebec's rule is about this particular kind of income, which is probably that it's taxable, then it belongs in the Quebec return. Now, Quebec has their own rules about what's taxable and what's not taxable. They are a unique province, as we all know. They beat it over our heads with it all the time. They are very unique. And because of that, it is possible that they don't think that this award is taxable. I don't know if they have a special rule for this particular award. If they don't think it's taxable, then you don't have to report it. But most likely, they think it's taxable. Because one thing about Quebec, they are different from every other province, but they do love taxing you. So they just make you pay the proper tax with the disallowed expenses removed. They don't add crazy fines on top. As I say, if they believe, and typically this is what they conclude, if they believe that it was an honest mistake, they do not add a fine on top. You're not fined because you have a difference of opinion over what should have been deducted or whatever. If they believe that that your heart was in the right place, there's no fine on top, just the tax. But if they don't think your heart was in the right place, there's a fine on top of the tax. Do we file Quebec tax returns? Yeah, we do. Yes, we do. We have to charge extra because they're a pain and there's a whole extra step to it. We don't like to, but we do it. We'll do a return for anybody anywhere in the country, rather. Very, very quick tax quiz. I'm not even going to give you a chance to answer this quiz question, which is, what special tax, see, this is when we're getting tired, imposed by Henry VIII, Elizabeth I, and Tsar Peter the Great, could only be levied against certain female circus performers and men? I will leave that up for a second while I answer this question. If my mom transfers me a bunch of funds for no reason, do I have to declare that on gross income? What's the cutoff amount? It's a gift. A gift is not taxable and it doesn't have to be reported anywhere. So if she just gives you money, she doesn't get to write it off or anything, so she doesn't get any tax break for it, but also you're not responsible for paying tax on top of it. Can you comment or explain on how to carry forward expenses to the next tax year? You kind of can't. Basically, expenses are expenses. They have to be expensed in the year. The things that you can carry forward really are capital cost allowance. So where you can choose not to make your deduction on your assets this year, and you can choose to have a greater amount to deduct next year. But expenses generally not really, unless you can, yeah, not really. There's yeah, not really. You can sometimes carry forward some income. If you have a 2-year grant and you get all the money in 1 year, you can use reserves to carry forward part of the grant into the next year, as long as the amount that you've carried forward is logical based on the work that you've done and not based on just what you want. You can carry forward the income, but the expenses kind of have to go in the year that you expended them. All right, the tax imposed on men and circus performers is, of course, if you haven't already guessed, the beard tax, where you had to pay a tax for having a beard, and you would get a little token that you could carry around to prove that you paid it. Filing deadlines. So deadlines are really super important to the government because paperwork is so important to them. And in general, making them wait for paperwork is a bigger deal than making them wait for money. As people, as human beings, we obviously think money is the big deal. And ultimately, of course, it is all about money. But from the bureaucrat's point of view, the paperwork is the primary thing that they want, and the money is separate and lesser. And we can tell this just by inferring it from their laws. So basically, if you file a piece of paperwork late, there's a penalty, like a fine. If you give them money late, there's interest. And so paper late, penalty. Money late, interest. And the penalties are way bigger than the interest. Okay. So like I said, filing a tax return 1 day late, you pay 5% of the tax. On top of the tax, you pay your tax and you owe an extra 5%, that's a penalty. The interest is nothing. The interest is 5% per year. So if you have the choice between filing 6 months late and paying right away, and paying at the time that you file, or filing 1 day late, and if you have a choice between making them wait 6 months for the paperwork or making them wait 6 months for the money, if you make them wait 6 months for the paperwork, you're going to pay a fine of 10% of your tax bill. If you make them wait 6 months for the money, you're going to pay 2.5% of interest. So their own rules make it clear what they prioritize. Paperwork. 5% penalty for being 1 day late. It takes you have to be late a year paying them to manage to owe them that much. So definitely know what your deadlines are. Anytime that there's a deadline for getting information, paperwork, documents to the government, get it in on time. You're going to have, at the very least, headaches and possibly fines as well if you don't get them paperwork in time. Don't worry if you can't pay it right away. You can actually manage that more easily than getting them paperwork late. As for the deadline, everybody knows April 30th is the filing deadline, except as a self-employed person, you actually get an extension. Self-employed people and their spouses get an extra 6 weeks to file. This is true even if you have a job as well as self-employment. Any self-employment at all unlocks this June 15th filing deadline, and also unlocks it for your partner, your husband, wife, spouse, common law partner. They also get an extra 6 weeks to file. After you filed, you have to keep these records, as I said, because CRA can come back to review things up to 7 years later. And so you really need to make sure that 7 years later, any questions they have about what you did and what you wrote in there can be defended. You have to be ready to defend. So to defend, you need paperwork. And what kind of paperwork? You're going to keep receipts, invoices, basically documents like that. I often get a lot of questions about whether you can just keep your credit card statements because it's a lot tidier. No, I mean, you can, but the CRA has a certain internal rule that says that they are not obliged to accept a credit card receipt as proof of an expenditure. They might if they're in that kind of mood, but they don't have to. So what you really want to do to cover your butt is register tapes, cash register tapes, email confirmations from the vendor, agreements for ongoing subscriptions, anything like that. One of the reasons that the credit card receipt doesn't function as a receipt is because it has to have a proper receipt, has the name and address and date of the purchase. So typically that is actually printed on a cash register receipt. If you've ever examined a cash register receipt, the address is always on there. And that is because that's what makes it valid. So do keep them. If all you have is a credit card receipt, I mean, it's better than nothing. This is better. These three things are better. Service agreements, if you have like a cell phone plan where they don't invoice you monthly, and instead they just take a bit of money off your credit card, then you might need the ongoing agreement to show what that was. If you don't have receipts, a good note, really, like a handwritten note by you, can suffice. For example, if you're trying to figure out how much you should have paid your spouse and you calculate it based on how many hours of work they did and what you would pay a stranger, and then you come to a number and that's how much you're writing off, that's how much you're paying them. That is just a note. There's no receipt or anything more official than that, but that note can help you defend yourself in an audit. I'm going to take a quick pause here to look at some questions here. Do we do Canada and US filing? Unfortunately, we do not. I'm working on getting a US tax specialist, on the roster, but I don't have one right now that I can recommend. I'm so sorry. We really should, and someday we really will, because it is very, very important to be able to, if you are a US person, you really need to file your US returns. Can you store receipts digitally? Yes, you can. I don't know. I mean, you can. Yeah, absolutely, you can. If you have like a receipt scanner, you can keep it as long as it's legible. Remember that thermal receipts, for example, fade. So even if you scan them, if you've waited too long and you scan one of those receipts that comes on the crinkly paper, it may be so faded that the scan is illegible. So try to scan them early, or if you can't, a little trick that you can use is use the photo setting on your scanner, and then you can actually, the photo setting can sort of pick up fainter gradations, and it can usually read a faded receipt better than the standard photocopier setting. But at the same time, it's like, why not just keep them? Just put them all in the shoebox, store the shoebox, put a date on it of when you can throw it out 7 years after you file a return, and keep the paper too. Why not? Physical receipts tend to disintegrate and die, and they are annoying. Digital records can also disintegrate and die. So, there's no winning, really. Anything is possible. What about scanned cash register receipts? I despise holding on to all that paper. Yeah, just like I said, stick a bunch of them down on a sheet of paper, photocopy them, make sure they're all legible, and you can probably throw away the paper. Go ahead, as long as the amount, the date, and the address are all visible on that receipt that you've scanned or photocopied, good enough. Okay, so car expenses. So we did explain that you're basically going to take, if you use your car for business purposes, and I do see that we're running out of time here, but I'm going to try to get to the end of the slides anyway. Car expenses, you're going to take the overall operating expense and take a percentage for business use. And how do you defend, because this is something that they also like to go after, how do you defend the percentage that you're using for business use? And the answer is you do it with a car log. Okay, that's actually a log car, and that shouldn't be there. Hold on, let's see. A car log, which is where you track the kilometers you put on the car for business versus the kilometers on the car overall. People used to do this on paper. You still can. Alternately, there are lots of phone apps right now that'll do that. So you're just going to turn it on as you head out on a in your car for a gig, and you turn it off when you come back home, and there you have a record of the kilometers that you spent. Make sure that you also take note of where the gig was and what it was, the date and what it was, so that if CRA says, well, what about this trip? Why are you calling that a business trip? You can actually refer to your notes and say it was a business trip because I was going, that was the day that I drove to, Sarnia for a recital, right? That you know the date and you know where you were going and you know why. I get a lot of questions as to what is the best system for maintaining your records. Do you just throw your receipts in a box? Do you use bookkeeping software? Do you use a spreadsheet where you keep it accurate to 3 decimal places? What do you do? Which of these is the best? Is it receipts or is a box of receipts best? Is a spreadsheet best? Is software best? And the answer is yes. Yes, they are all best. They depend on you. So it's choosing your record keeping system is like choosing your fitness system. It's not the most perfect system. It's the one that you can consistently do. Because incomplete records that are really precise but missing 8 months, useless. Whereas incorrect, like a little bit off records, but they're for the whole year, are useful because they're probably not too bad. It's a bit like, the joke is, that a stopped clock is better than a slow clock because at least a stopped clock is right twice a day. But the reality is, of course, we know that we'd rather, if we have a clock, we'd rather that it be a little bit slow than stopped, because a little bit slow will still give us information. And that is the equivalent of in a not perfectly accurate but consistent record keeping plan. So whichever thing that you think you can do, if all you can do is throw things in a shoebox, then do that. If you love spreadsheets, then do that. If you love bookkeeping software, do that. You don't need to use bookkeeping software if you prefer a box full of receipts. It'll be fine, I promise. Everything I'm talking about here is stuff that you can do. It's a burden to be self-employed and be trying to stay up to date with your taxes and be trying to be consistent. It is. But it is so much easier to stay out of trouble than to get out of trouble. And I know this from many sad stories that have come through my door over the years. If you do what I've asked you to do, keep your receipts, set aside money for tax, know your filing deadlines and obey them, you will stay out of almost any kind of tax trouble it's possible to get into. Okay, I call it good tax hygiene. And it's a lot like flossing. I hate flossing. It's annoying. It's boring. It's tedious. And sometimes I bleed. But the benefit is I don't lose a tooth. And anyone who's lost a tooth will tell you flossing is not as bad as losing a tooth. So do what you need to do. Be consistent with it. Don't fall behind or don't fall too far behind. And you should be okay. All right. And that's all I have for you. We're way over time now. I don't really think that I can answer any questions that you might have now. If you do have some questions, you can contact my office. We will do our best. It is tax season, so we are just crazy busy, but I try my best to dash off responses even in the season if there's something you need to know that I didn't cover and that isn't in the resources that I hope you'll all go ahead and download at your earliest opportunity. And I'll hand it back.
Sunny, thank you so much. I don't think there's ever enough time to cover all the nuances of what we were discussing today. So again, a big thank you for taking your Saturday to be with us. It was incredibly insightful, and I personally learned a lot. So yeah, thank you again, and thank you everyone for joining us today. And we wish you all the best. Bye now.